work ethic will take you further than talent because talent can't take you anywhere on its own.
I just want to own 100 properties and I want to be set.
I think I'm obsessed with real estate and
Okay.
what I do.
A lot of times people think it's money, and I've very rarely found that it's money. From a tennis coach to $110 million in multifamily. This is Farris' story, and I think you guys are going to be absolutely blown away.
Hey guys, my name is Farris Gosea. I'm originally from the United Kingdom and came to US to play college tennis when I was 17 years old. I went on to play pro tennis and got to a career high of 400 in the world. At the age of 24, I got into real estate investing to give myself more time and more freedom. At this point, I have $110 million of real estate assets in my portfolio between multifamily and single family. And if you want to be successful in real estate, I can tell you to think bigger and think quicker. If you want to buy 20 properties in 5 years, you can make that 100 properties in 2 years. If you want to go further, think bigger.
So Farris, you got into real estate pretty early in life, right?
Yes.
What age did you get in?
24 was when I bought my first property.
24 years old. So at 24, man, what was the impetus that got you into real estate? What did you do before that?
Prior to getting into real estate, I was actually playing tennis. Grew up playing a lot of tennis. Went to U of I for the purpose of tennis.
Okay.
Played professional for about a year or two. Got to about 400 in the world, and then started tennis coaching right after that.
Got it. So basically, you were not playing tennis like most of us. You were playing tennis professionally.
Correct. Yeah.
Okay. Was there somebody in the family that played tennis, or what was it? Or you were just kind of natural gift and hard work?
I think a little bit of both. I was actually kind of chubby as a little kid, so
Okay.
they were like, "Hey, man, you got to go do something."
Okay.
So I picked tennis and ended up being pretty good.
Okay, got it. So what does it take, like in the world of tennis, to be number 400
Yeah.
in the world?
Yeah.
Right? I mean, this is no joke, right? This is some serious work. And a lot of people have thought about, well, I could have been a baseball star or this or that. What does it take? I mean, is this like a dedication of a lot of hours of practice? What does it take?
Yeah, I think it takes the basics of what people think it takes just over a long period of time.
Okay.
Consistency, dedication, doing the small things and doing them correctly. Not to say I did them perfectly. I could have done them better, but just doing the right things over and over again over a period of time.
Okay. So in your opinion, what makes somebody, say, 400 versus 300 versus 200 versus the top 10, let's say?
It's a great question. Doing the right things over a longer period of time and doing them a little better,
Okay.
doing them a little longer. The extra 5 minutes in the stretching room, things like that, just over a period of time really compounds itself.
Okay. And in terms of like whether it's your technique, whether it's your, I guess, some of the physical aspects of the game, right? Is there a huge amount of difference between, say, somebody who is a, kind of a pro versus people who are at the top end of it? You think part of it is, besides hard work, part of it is just you're born with certain skill sets?
Yeah, I think people are born with tendencies to be better at things than other people. Height differences, weight differences, things like that, and also just coordination and skill. At the top end, obviously, Djokovic has been very, very dominant for a long period of time. Nadal, Federer, same thing. For them, I think different class.
Okay.
Just something completely special. Everyone else, just little things are better here and there.
So what do you think is more important, the work ethic or just pure talent?
I think for a lot of things, work ethic will take you further than talent because talent can't take you anywhere on its own. But work ethic on its own can take you a lot further than just talent.
Are there any similarities? Because obviously today we're going to talk about multifamily, right? That you feel maybe the work ethic, maybe the mindset, maybe your dedication in terms of discipline that apply in being a great tennis player versus real estate?
Yeah, I think massively. There's a lot of things that bled over into my real estate career or business career that have helped me. And what I do now feels a lot easier than what I did then to be a tennis player. So it helps.
Got it. And in terms of, so I hear an accent, right?
Yes.
Ethnically and in terms of, I guess, nationally, where are you from?
Dad's from Libya, mother's from Wales.
Okay. And then, so you grew up in Great Britain?
Grew up in Great Britain, Wales. Yep.
Okay, got it. And what age did you come to America?
Came here at 17.
17. So talk about the transition. Did you decide to give up kind of tennis on playing on a pro level, taking it to the next stage, or was it like an age thing? Or what was the impetus to getting into real estate?
There was a multitude of things. I was actually trading stocks at the time of getting into real estate. I took a Series 7, Series 4, trying to do stock options. Didn't like it, very volatile. The more I learned, the more I realized it was kind of like gambling.
Got it.
Parents owned 6 houses back home. They said, hey, you can't just get in and out as quick if you're nervous about it. And, over time it should be, a winning strategy. Why don't you try buying some real estate? And I thought, okay, that sounds like a good, thing to try out and see if I like it.
So you're playing tennis, then you start coaching.
Yep.
Right? And so real estate was something like a long-term strategy initially. Is that kind of how it started?
How it started was I knew that, I didn't want to spend all of my time doing something that I might not enjoy.
Okay.
Coaching is fun to an extent, but when you spend 40, 50 hours on court, you might not enjoy all of them. So I thought, okay, this gives me the opportunity to be flexible with my time and hopefully give some of that back if I don't want to do, as much coaching as I do right now.
Got it. All right. So basically it was, you kind of started developing a plan B while you had a plan A in place.
Correct.
Right. So can you talk a little bit about, there's a lot of people that everybody wants to either do stocks, crypto, real estate, obviously, right? And they want to get rich tomorrow and they want to quit what they're doing today, right? Was there kind of a strategic approach? Like nobody becomes good at tennis overnight, right? Doesn't matter how talented you are. It takes a time and there's a step-by-step process. So if somebody says, hey, Farris, I want to do what you do today and I want to do it tomorrow, what would you say?
That's tough. I mean, a lot of people say they want to do what people do tomorrow,
Right.
but they don't actually want to do what you do. People see the success, but they don't see waking up at 6 and going to bed at 1 and doing everything that's necessary to have that. So I think it just starts off with discipline. And realistically, if you want to get into real estate, just vetting out, single family duplex and seeing, okay, what works, numbers, areas, things like that.
So
The
hold on,
basics.
man. I mean, I want to just do multifamily. I only want to do the big stuff. Why would I bother doing small properties? Why do I care? I just want to own 100 properties and I want to be set.
So if you want to own a 100 unit and it's 10 million, if you have 3 million in the bank, it's an option to go do that.
Because the reason I asked that question, obviously it's a rhetorical question.
Yes.
There's a lot of times people will hear something like this,
Yep.
right? They're like, oh my God, Andrew had Farris on. Man, I want to skip all the small stuff. I'm just going to go do the big stuff, right? That's like you want to basically be a pro at anything, but yet you don't want to put a practice in. Is that what you're saying?
I think so. I think a lot of syndications fell victim to that in the last few years of trying to have a bunch of GPs in the deal and raise a bunch of investor money, didn't know what they were doing, handed off to third-party management, and great, you're a GP with 10 other people on 15%. You own a duplex.
Right. Okay. I'm so glad. So break that down a little bit and do it a little bit slower.
Okay.
Right? Because you covered a lot there.
Okay, yeah.
Right? So I want you to just kind of break it down in portions. So number one, explain what is a syndication. Just imagine somebody new listening to this. What is a syndication?
Syndication is where you go out and raise money from investors. There may be a group of you, it may just be yourself, who identify a property and then identify the capital for that property and say, okay, I'm going to own either 10, 15, maximum usually 20% as the person putting this deal together, putting the funds together, putting the loan together, and the investors will own 80% of this deal, and their upside is capped to a certain percentage, and based on the metrics of the deal, et cetera, that's how you'll get paid for putting it all together.
Got it. So why would somebody do a syndication, right? Versus, let's say, I want to own a 100 unit, right? And now, like you just mentioned, that if it's a $10 million deal and I don't have the $3 million, are you telling me that syndication is one way of going about it?
Correct. Syndication is one way of going about it. And then when people say, I own that deal, be very careful if they own it or are they part of a GP, that they were the piece that maybe sourced the deal and that was it and they own 1% of it.
Got it. So explain the difference to me whenever somebody does a syndication. What is a GP in that and what is an LP in that?
The GP is someone who's actively involved, whether it be finding the deal, finding the money, the management of the deal. There's multiple things that I've heard about a person being classed as a GP for a deal and what that means. An LP means they have really no management or involvement with the deal. They're just placing capital and there's a promise of a return on that money. It's not guaranteed, But obviously, in the offering, they say, you know, hopefully we pay you 7% a year for X amount of years, and then X amount on the back end, and the internal rate of return is around 17 or whatever they say it is.
Okay. So GP basically is your general partner.
Correct.
LP is a limited partner.
Correct.
So easy way of understanding it is that the GPs are going to basically identify the deal, vet the deal, maybe do the management, maybe raise the capital, all the things that go actively managing a business. In this case, it may be an apartment building.
Correct.
Correct?
Yes.
And then LPs are, say, it could be your mom, your dad, your aunt, uncle, or a bunch of other people, right? Be it accredited, not accredited, depending on the offering,
Yep.
that are saying, hey, I'm going to invest my 10,000, 20,000, 100,000, or $1 million.
Yep.
Right? So you got to think about it from those two perspectives, those two roles.
Correct.
So when you got in, when you're teaching tennis, on the side, you started getting into real estate. And you mentioned your family had 5-6 houses back home.
Yep.
Right? Was there a kind of a strategic approach you took initially? What was kind of your first property? You got into multis, but what was your first property?
First property was a single family home in Munster. Actually,
Munster, Indiana.
Munster, Indiana.
Okay.
Got off the phone call with my mother, downloaded Realtor.com, scrolling on the app, I saw a 100K half duplex in Munster, and I was like, it seems pretty cheap for a half duplex in Munster. So I called a realtor and literally put it under contract. Didn't know too much. I just went for it.
Okay. So basically, you were just like, either you were very smart or you were not so smart. Didn't matter, but you were going to take action.
I was just going to take action and kind of figure it out from there. And it seemed like, based on Munster as the area and what it could rent for, it seemed like it was a decent deal.
Got it. Okay. So at the time, was this a value add? Was it just like, well, let me just see what happens? Was it in decent condition? What was it?
It was a good house in decent condition. I knew nothing about construction. I know more now. Didn't know anything then. Every little thing freaked me out. Good house, good location, nice property, well maintained. Thought, okay, should be easy enough to rent out. Let me try it out. Obviously figured out the cash on cash.
Sure.
20-something%. I was like, that sounds pretty good. I'll try it out and see how it goes.
Got it. Okay. So when you bought that house, did you buy it with your own capital? Did you borrow some of the money? How did you execute that deal?
It was my own capital. Initially, I was going to get a loan on it, and I saw the lending fees on the thing they give you. And I was like, wow, like $3K to get a loan? This is crazy. So I went and bought it cash, which was pretty, again, now I understand leverage and all that stuff, but at the time I bought my first one cash.
Cash. Okay, got it. And then at the time, how long were you in that deal?
You mean how long did I own it?
Yeah.
I just sold it 4 months ago.
Okay, 4 months ago. And when did you buy that?
I bought that in November 2018.
Okay, 2018 is when you bought it, and you just recently sold it.
I did, yeah.
Okay, and what did you sell it for?
I sold that for $172.
172. Okay, so you have a good bit of capital gains in that particular property. Are you doing just a regular sale or like a 1031 or anything out of it?
Regular sale.
Just regular sale, getting rid of the property. So what was it like? How did you start from there and go to the next versus buying your first multi?
It's a great question. So from there, for the next 3 years, I bought either single family home, duplex, or 4-unit. And then the first multifamily I ever bought was actually a 14-unit in Cherville, Indiana.
Okay.
Well, this is one of my first ones, so I did partner 50-50 on this one.
Got it.
And it just seemed to make sense. Cherville, very good location. Rents I knew could be $1,100 plus. It was like in the high 60s a door. Just seemed to make sense. Was a little nervous getting into it, obviously a bigger building.
Sure.
But I just, we went for it and it worked out.
Got it. So at the time, what was the strategy you're using in terms of identifying a property? Because obviously, multifamily has been very hot last few years, right? So for you, what was the strategy? Was it on market? Was it off market? How was that?
Some of the things I bought were on market in those first 3 years, not many. I was actually doing a ton of outreach, cold calling, text messaging owners, things like that. To this day, mostly the deals I do are, off market, again, direct to seller. So, my strategy was vet a lot of deals and find the ones where the owner is just seemingly a little off on what it's worth.
Got it. All right. So a lot of times, right, people hear this term off market, right? And they think there is some sort of a secret list. There's something, right? I mean, everybody wants the latest secret.
Yeah, correct.
Right? And what people don't realize is every market, every property that's not listed on the MLS, it's a damn off market deal.
Correct.
Right?
Yeah.
It really, now you may have a probate, you may have a foreclosure, but every damn property. It doesn't really make any difference if
Yeah.
it's not listed actively on the MLS.
It's off market.
It's an off-market deal.
Yeah.
Right? We all drive by millions of them
Yes.
every single day.
Correct.
Right? So I guess that leads me to the next question, which is that do you have a secret list?
I do not have a secret list.
Okay.
I wish I had a secret list.
So then what are you, and then do you have a secret method of reaching people?
We use some softwares like CoStar,
Sure.
obviously, is one. Reonomy is another one. I know PropStream, people use
Sure.
for single families. We don't
Right.
really use that too much. So we do use some softwares, and then we obviously outreach to them and ask them if they would entertain an offer.
But man, you're telling me that these are softwares. I mean, you're using CoStar because you're obviously looking for more multifamily deals.
Yep.
They track that. Certain people will track that data more than others. I mean, that's really all it is at the end of the day.
Yep.
And then are you guys doing outbound calls, texting, mailings? What has worked for you guys?
Calls and texts.
Okay.
For multifamily, we really don't think the mailing works.
Okay.
It's more of a single family thing.
Sure.
But yeah, calling and texting and just seeing if they're open to an offer, creating a relationship.
Okay, got it. And so basically, I mean, this is pretty similar to what somebody would do in the single family space, right? You're reaching out, figuring out if there's a need, and just because there's no need today doesn't mean 8 months from now it's not there, correct? And then you're cultivating a relationship, and obviously, so let's say somebody wants to get in that space, right? We had kind of touched upon early on a little bit about syndications, right? Your method of buying, because obviously your first property you bought was a partnership, right? Why haven't you gone down that syndication rabbit hole? Because a lot of people, especially in the last 3-4 years, it's been an easy way for people to get in.
It's been an easy way for people to get in, but they don't make that much money on them.
Okay.
Like the cash flow, for example, for someone who's a GP in a 100 unit could honestly only be $300 a month.
$300 a month.
It could be very small,
Right.
right? If they own a small part of the GP, even if they own a large part, it's still not much. And then most of the upside is given away.
Right.
So that's why I think that even if you're going to own 20% of a 100 unit, you're better off finding your own 20 unit, because why would you want to deal with 100 units?
So hold on, man. You talk too fast.
Sorry,
Slow
sorry,
down.
sorry.
Right? Slow down.
Yeah.
Right? Because this is an important point what you're
Yes,
making.
yes.
Where explain that in short segments. So because a lot of times what people think, right? And there's a lot of multifamily operators, oh my, bigger is better, bigger is better. And what people don't understand, it's like, think about this. Right? You own one share of Apple.
Correct.
You probably own a toilet seat somewhere at Apple. Right? You're not even sure
Yeah.
if it's the damn toilet seat or if it's the screw on the toilet seat that
correct.
you own.
Yeah.
Nothing wrong with it.
Yes.
Right? There's nothing wrong with that. But what you have to think about is, hey, where am I going with this?
Correct.
Right? Just to own, saying, I mean, I have some people I know, they're like, man, we own like 8,000 units. I'm like, wow, great, wonderful.
Yeah.
Right? How come you don't have any money?
Yeah.
Right? If you own 8,000 units, because
Yeah.
aren't we doing this for cash flow? Aren't we doing this for building wealth? So let's put our ego aside. And you made a very important point. So explain that again a little bit slower so people understand.
Yeah, so I think a lot of people in the syndication realm do get caught up on the unit ownership. But again, they're in a GP. There might be 3 people that own the 15% of the deal, which is the general partnership. And out of that, you have to give away a lot of upside to the investors who are in that deal. And when you look at it now, and again, people probably aren't tracking this, but a lot of these syndications are having major problems with, capital calls, rates went up, taxes went up in the Sun Belt, prices were just getting outrageous. So there's a lot of issues. And when they're not really invested in the deal because it's the acquisition fee that sometimes they roll in, things can go wrong.
So they're making money on the acquisition fee, meaning on the capital raise a lot of times, right? They're taking a piece maybe of the management,
Yep.
right? They're taking a piece maybe of the disposition,
Yep.
right? So bigger is not necessarily better. You have to look at the quality of a deal. I mean, I've always been, you can literally own a 10, 15, 20 unit building and make a shitload of money.
Correct.
Right? Because number one, you bought it right, hopefully.
Yep.
Right? You're not competing with very sophisticated sellers.
Correct.
Right? You can probably actually add value
Correct.
in those plays. So that's been kind of your approach, that be very strategic rather than just go big just for the sake of it.
Yes, the best way to put the syndication model is it's more of a hedge fund model.
Got it.
In where they're making money on the money they're raising,
Right.
rather than the deal itself. And when you look at how many deals traded in Arizona and how fast, for example, a company like Rise 30 whatever grew,
Sure.
how do you buy $5 billion of good deals
Right.
in 2 years?
Right.
I can't find that many.
No, but you're not buying good deals. You're just buying because somebody's good at raising capital.
Correct.
And you get paid just for the sake of transacting.
Correct.
Right. And that's a very bad play, right? Unless you're just a big enough company where you do that play and then sell out and you cash out. Right.
Correct. It's a horrible model, and again, it opens yourself up to many, many risks when you have to dispose of them.
Sure.
Within a period of time. Rates go from where they were to where they are now, and it's not good for the value of the property.
Got it. So other side of it was like in your case, right? You're like, okay, I'm going to go after a smaller property.
Yep.
Right. And I'm going to kind of start there, start cutting my teeth there, because you get to understand, number one, how do you look at the numbers? How do you look at the financing? How do you look at what is going to happen? How management is much easier. Right. So this property in Treeville at the time when you bought it, was it a kind of, we didn't know values were going to rise at the level they were going to rise.
Correct.
Right. Obviously. But were you guys going to basically improve management? What was the thought process at that time?
Thought process was all the rents were $700, I think, around that. I thought they could be over $1,100. Today, I think we're pushing $1,300 on some of those 2 beds. And I just thought, okay, if we can get the rents up and, people are willing to pay more. I had my comps because I owned others in the area, thought I could do that. The deal will cash flow nicely. And obviously with that comes, value appreciation or value add, whatever you'd like to call it. But the value of the property can be higher with higher rents.
Got it. Okay. So it's a pretty simple, straightforward deal. No different than a single family. It can be a duplex, triplex, fourplex.
Yep.
This is, you're looking at what they're renting for today, right? Where the market rent should be, right? And then basically, because it's a multi-unit building, it's going to be at the end of the day based on what your cap rate is going to be.
Correct.
Right? So how did you find that property?
Outreach to owner.
Outreach to owner. So
Yep.
basically off-market secret property.
Secret list.
Secret list, right?
Yeah.
Okay. So on that, what did you guys pay for it at the time?
At the time for those 14 units, I believe we paid right around $950.
$950.
Yeah.
And you guys came up with some money with the partner. Was it like you guys split what you guys were going to put in, or how did that come about?
Yeah, we split exactly what we're going to put in.
Okay. Was it 20% down, 25% down?
I believe 25.
25% down.
Yep.
And any capital rehabs it needed?
No.
No. So it was a pretty good condition.
Yeah, good condition.
Building. Okay, got it. So I guess that's the next thing comes up is a lot of times people feel you have to buy a broken down building,
Yep.
right? Is that the case?
No.
No. Okay. So in this case, was it just the kind of the owner was like a tired landlord, not paying attention to management? Because why were they not raising rents?
Just uneducated.
Okay.
Uneducated on value, uneducated on rent.
Okay.
Things like that.
Got it. And then did you guys just go to a local bank? How did you guys find a lender?
Yeah, local bank that I knew that I had done a couple other deals with.
Okay.
Networking with other people. And, I think people don't value enough asking other people like, hey, who are you using? And trying to network to find lenders in the market.
Got it. All right. And what was deal number 2? Do you guys still own it?
Still own that one.
Still own that one.
Yeah.
You didn't dispose of it.
I haven't sold anything that's above 4 units.
Okay, got it. All right.
That single family was the first thing I've ever sold.
Okay, got it. So,
So-
you're basically, you kind of go without thinking, hold it for long periods of time, right? Keep making cash.
Yeah,
Right? Okay,
yeah,
got it.
yeah.
So what was the second play?
Second building was actually a month and a half after that one. It was a 28-unit building in Hobart, Indiana.
Okay.
Yeah.
So my question, man, why stick with Indiana? Because you have a city which is next door, which is Chicago, much bigger buildings. Why not go to Chicago?
The laws here are not very good.
Okay.
Landlord-wise, I don't think that the return on capital is as good. Actually,
Okay.
Northwest Indiana has gotten really, really pricey
Okay.
in the larger buildings, so that doesn't really work too much anymore.
Got it.
I am in Southwest Michigan.
Okay.
I'm in Central Indiana. I'm going to be buying something in Champaign, so South Illinois. So I'm kind of expanding out, but to me, I haven't found anything in like Chicago market that remotely makes sense in a larger building. And that's for me. That's what I
Sure,
invest for.
sure.
Different people invest for different reasons and manage different ways, but for the things that I look for, I haven't found anything that really makes sense to me.
Okay. So let me ask you this, because I've always felt that boring markets are better. This is just me, right? That boring things are better because they are the ones that are ignored the most, right? And you can make huge numbers on boring things because most people are not paying attention to that, right? From what you're saying, you seem to be buying things that are kind of boring.
Yeah, I mean, it depends on people's definition of boring. I mean, I like money.
Right.
But yeah, to most people, maybe it's boring. Yeah.
Right. No. So what I mean is that like these are markets that a lot of time they're overlooked, right?
It's not a sexy growth market like Phoenix, Arizona.
Right. Exactly. Like Austin, like Texas, like
Yeah.
Florida,
Where they're
right?
building way too much.
Correct.
Yeah.
Right. I mean, that's the great part about the Rust Belt of America, which is the Midwest.
Yep.
That there's a lot of small markets where they don't. There certainly institutions are not going there.
Correct.
It's too small for them.
Correct.
Right. It's too small for the quote unquote your all your operators who are raising capital.
Yep.
Right. And it's not sexy, but yet it can be very profitable.
Yeah,
Right?
absolutely.
Okay. So as far as in terms of your second play, you were saying, did you buy it with the same partner or somebody else?
Yeah, that one I did buy with the same partner actually.
Okay, got
Yeah.
it. And so clearly that partnership has worked out.
Yeah,
Okay.
it's good.
And then do you guys both do management or one person is more responsible?
At the time, we both did it. We were he was dealing with maintenance stuff. I was dealing with renting the apartments, leasing, tenant inquiries, things
Sure.
like that. Obviously, now I have 20 staff that deal with kind of the whole thing.
Got it.
So we're not really involved too much with that. But yeah, at the time, we kind of split it 50-50 and dealt with it that way.
Got it. Okay. And then the second deal was how many units you said?
28.
28 unit. Okay. So 28 unit property, what did you pay for that one?
That was actually brought to us. A broker actually had it passed out to a few people in the market.
Okay.
And a person I knew with 20 units said, "Hey, did you see this one?" I was like, "Oh no, I didn't." And I looked at it. I drove there and I wrote an offer immediately. It was 1.68 or something like that.
Okay, got it. And then for both these deals, was this some capital you raised? How did you guys come up with the initial capital for you?
So the 28 unit actually, we had the money, but I had a friend who wanted to lend 300K at the time for 6%.
Okay.
So we just used that as a down payment.
Got it.
And we really put no money in that one.
Okay, got it. So basically, this is kind of private money, not syndicated money. This is just private
Yeah,
money.
just private
that
money.
You guys got. Okay.
I kept my money away for more deals.
Okay.
And he wanted 6% on it. He took a second lien position. Very rare to find someone that
Sure.
won't do that, but we had a good relationship. So that's what we did on that one.
Okay, got it. A lot of times, I think people ignore that, right? And a lot of times, people they don't take the time to build that relationship with people because this is key. Like
Yep.
in these kind of situations, that people will trust you if they know that you're a serious person.
Yeah.
Right. I mean, if you're that guy who all the time, all you post on your Facebook is about sports and about crazy stuff, and people don't look at you seriously,
Yeah.
and tomorrow you're going to be Mr. Donald Trump,
Yeah.
right? It's probably not going to happen.
Correct.
Because people really think of you, whenever there's some sort of a jackass kind of stuff, go to you.
Yeah.
Right. So you're the local jackass.
Yeah.
And then now suddenly you're going to be Mr. Entrepreneur.
Yep.
It doesn't work. Meaning you have to be congruent with whatever you do in life. Right.
Yes.
So after 28 unit, what comes next?
After that one, there was a 32 unit,
Okay.
a 17 unit, and a 15 unit in Valparaiso.
Okay. So again, similar kind of geographic area.
Yep.
Right. Okay. And this one also a partnership?
Same partner.
Same partner. Okay, got it. All right. And so as far as the cash flow that was coming in from these things, at that time, did you go get your real estate license or what were you doing in terms of making a living?
So at that time, I was still coaching a little tennis, not
Okay.
too much, and I did have a license.
Okay.
I wasn't using it that much, but I was doing some stuff, and at the end of this year is when I got more heavily into brokering.
Okay, got it. All right. So, my personal feeling always has been that when you're building something, don't start basically picking the fruit yet, right? Give it some time and let it grow a little bit
Yep.
before you start trying to get paid from it, right? Is that something you believe in?
Yeah, I mean, all the money I make, I just reinvest in buildings and buying more.
Okay.
Yeah.
Got it. Because you don't have because we're looking for a formula that's legal, ethical, and moral to get rich overnight. So if you find one, man,
Yeah,
please
yeah.
let me know. Now you know where our office is, right?
Yes.
But that doesn't exist,
No.
right? That it takes a period of time to kind of build, scale, kind of prune a little bit, get rid of some things that may not be perfect, right? And then go back to it.
Yep.
Right. So that's kind of the philosophy you guys are using, basically, clearly, right?
Yes.
And so whenever you're looking at a building, are you focusing on cash flow? Are you focusing on equity growth? What is more important to you?
It was different in the beginning. I
Okay.
think in the beginning, I was focused on the cash flow of the property.
Got it.
Because I wanted to get my time back, and I would do that with cash flow.
Okay.
Now I realistically care about how much money can I get out of this thing.
Okay.
Like where can it appraise at?
Okay.
Basically.
So on the refi end.
Refi end, correct.
Okay, got it.
And again, you have to have cash flow to be able to refi.
Sure.
But I care a lot about the refi.
Got it. Okay. Because you can actually get a good chunk out of it and not have to pay tax on it, and it basically becomes liquid cash to go redeploy again.
Correct.
Okay, got it. So have you guys done that where you bought a building where there was a lot of upside on the back end, where you just basically went, fixed the property, managed it properly, and then refied out?
Pretty much a lot of the deals we have, like that 28 unit, for example, 9 months later it appraised at 2.9.
Okay.
So pulled out about $1 million.
$1 million cash. Okay, got it. And then you guys redeployed that cash.
I did.
Okay.
Marcin kind of slowed down. He's a little older.
Okay, got it.
But I did, yeah.
Okay. So, people tell me all the time, Andrew, it works for these people like you're special, right? It works for people like me. It just doesn't work for them. What do you think their problem is?
It's either knowledge or hustle, determination to work, things of that nature. But what we do, especially in real estate, is not something that takes extreme technical knowledge. If I have to go build a rocket for SpaceX, maybe I can't do it. I don't have that kind of skill or how I think. But this, it's just determination, in my opinion.
So you played tennis at a pretty high level, right? I mean, this was not like your amateur thing, right? To me, a lot of that is based on talent, right? Part of it is genetics, part of it is where you're born, who you're born to, a whole host of things.
Yes.
In real estate, I mean, 99.99% of people. In fact, the smarter you are, you're going to have a hard time because you're going to talk yourself out of it.
Over-analytical. Yep.
Right, over-analytical, and you're going to have every reason in the world that doesn't work. I think, yet, real estate is a learned skill set, right? Would you agree with that? That it's a learned skill set and that anybody can learn the skill set.
Yes.
Right? And it's much easier than a lot of other things, man. Right?
100%.
So, because to me, it's like, this is always interesting. We will work harder on a corporate job for somebody else,
Yeah.
For pennies,
Yeah.
than we will, for ourselves.
Yeah.
Right? So today, what have you scaled up to?
Today, my portfolio looks around a little over 1,000 units.
Okay.
And out of those, I personally own about 700.
Okay.
So that's taking into account the partnerships.
Got it. All right. So basically, you've kind of strategically partnered on things where it makes sense. On other ones, you've kind of just done it yourself.
Yes.
That's basically what your play has
Correct.
been.
Yeah.
Got it. So for somebody who's looking at the market today, right, are you still in today's market, I mean, which everybody's crying, oh my God, it's crazy, it's high, it's so on and so forth. What's your take on that?
My take on it, there's a deal everywhere to be done. I think I have about 400 units under contract right now, varying locations. If you're doing the right things and looking in the right places and creating relationships, I think there's deals to be done no matter the size, where it is. Again, there's less at work, but there are out there.
Okay. So what is your secret? I mean, clearly, because generally for most people, they don't scale up at the pace at which you've scaled up. And even a lot of times people think it's money, and I've very rarely found that it's money. Is it that you're that passionate, you're that dedicated? What the hell is the deal?
I think dedication is there. I think I'm obsessed with real estate and what I do. And I think that, I haven't gone out and spent the money that people would probably spend in my position on varying things.
Okay. Got it. So basically, you plow back every penny you can in real estate.
Yeah, and I think also the long-term goal is also a reason how fast I got here, because my long-term goal is 50,000 plus units.
Okay.
And I think someone that gets into it thinking, I want to eventually own 20 units,
right,
it's going to look a lot slower for you because your mindset isn't like bigger and expanding quick.
Got it. So where does this mindset come from? Was it from your parents? Where did you get this type of mindset? Because that's not common.
From playing sports, I think. I've always wanted to win.
Okay.
So whatever I do, I want to win at.
Got it. But in sports, I mean, you can have a small injury, you can have a bad day, you can have a lot of shit go wrong, and not be the best at things.
Yep.
But here, real estate is a lot easier than sports.
It's a lot easier, but every day you win some, you lose some. I think over time, if you continue to win more than you lose, it's great. But you'll even win in the hour and lose in the hour.
Right.
So you're always winning and losing in business, and it's very interesting.
Got it. So anything that I have not covered. So actually, let's talk about this in terms of management, right? Self-managed, or like you built a team in-house, or you sub it out?
Yeah, built a team in-house. So went from self-managed to obviously then growing a small team into a larger team and continuing to add to that team.
Got it. So you're basically, you have kind of your fingers on the pulse.
Yeah, I have my fingers on the pulse like all day long. I'm
Okay.
not the one like doing the actions.
Sure.
But I have to maintain, oversight of the operation.
Got it. Okay. And you're still kind of geographically concentrating in, the north west side of Indiana, kind of south side of Michigan. Is that kind of your area where you are? Or are you expanding out?
Yeah, then central Indiana, so Rochester, Plymouth, Indiana, Warsaw, places like that. And then Champaign, we have something under contract. I would buy in Wisconsin, Iowa, most of the Midwest. I just haven't found something that works for me right now.
Got it. All right. And then today, do you have a dedicated team of people who do the calling for you? Have you subbed out that function also? Or is that still remaining with you?
So we have a brokerage and a lot of fantastic brokers that work with us. And again, if someone brings a deal that I think I like and it works for me, then obviously I just pay the brokerage fee to the broker, and the broker's like a deal got brought to me.
Got it.
A lot of deals do come from other brokers to me now. I think a lot of people don't understand the value in just being a good buyer and just saying yes and going with it, and not arguing over 10K because that broker might not call you back.
Got it. All right. So, I mean, you're saying this is number one, you have to understand values.
Yep.
Right, for sure. Then number two, you have to understand relationships, because a lot of these things, especially when you're doing business with somebody, a lot of these boils down to relationships. Because if they know you can perform, you can close, they will send you the deal.
Correct.
Right? So where do you think the market is heading? Because we've been in a crazy market.
Yes.
Right? Rents have been crazy. Everything's just been absolutely crazy.
Yep.
In general. Where, according to you, is it going in your space?
In the Midwest area?
In the Midwest area.
In the Midwest area, I think it's going to plateau a little bit.
Okay.
I don't see major appreciation of the assets right now.
Got it.
I think obviously there's always deals to be done and buying below where the market's at. And then I think rates might come in a little bit. I don't think they're going to pull back massively over the next year or two. So I just see stagnation and rents to tick up a little bit is my current opinion. And Sunbelt in that area, I think rents are going to go down. Value is going to go down.
Got it. So this whole instability that we've seen in the rates, where they've just gotten straight up, right? That's put a lot of people, especially in the syndication model, right, in a hell of a spot.
Yes.
Right. What's your opinion on that?
My opinion on it is it was deserved. A lot of people went out and raised capital who should never be raising capital, not buying real estate, didn't know anything about it. And, I think it depends on how high these rates stay for how long and how many people are going to get damaged by that. I mean, office is definitely getting crushed. Multi, I think if they keep rates here for the next 2-3 years, you'll see a lot of pain. A year, you'll see some pain, not as much.
So what about for operators like you? Because obviously, as the rate has gone up, right, it becomes more expensive to buy property from one end of it, or to hold property, I should say.
Yep.
Right? How have you hedged yourself against that?
I actually like the rate increases because then the value of the property you're buying is going down because of the rates.
Okay.
But it's only a snapshot in time that property's value is down. And when you think about, okay, where am I thinking these rates will be over the next 30, 40 years? Do I think the average is going to be 7.5? No, I think it'll be lower. So then you're buying at a discount to where the value will be over a long time.
Okay. So that was a mouthful. So explain that.
Yeah,
right?
okay.
So explain why, because this is something people don't understand, right? That actually some distress in the market is good for the operators that really understand the market. That's basically what you're saying.
Correct.
Right?
Yeah.
So explain why rates being high and from time to time things going nuts, it can be very, very lucrative.
Yeah.
Right? So explain why the rates today being high is good in terms of the value of the property, because the value of the property comes down.
Correct.
When the rates are high
Correct.
in your space. So can you just break that down a little bit?
Yeah, so obviously in the multifamily space, things trade on a cap rate basis. And when rates are up, deals can't pencil, lenders can't get the money out the door. So the value has to come down to accommodate that asset trading. So with the value down, if you're thinking, okay, our rate's going to be over the next 30, 40 years lower than where they're at today, you're going to see the value be higher than what you paid for it if you bought it right.
So kind of to explain it, right, if let's say 2 years ago, the value of property was 2.5, right? At a rate where, say, back-end rate was about 5%, 5.5.
Yep.
Today, the rate is 7.8. So that same $2.5 million property may only trade at $2 million.
Correct.
Right? But yet, you bought it at $2 million. You have the ability to be able to hold it, to be able to improve rents or to be able to get better renters in there, manage it better. 5 years from now, 8 years from now, when the rates go back to a stable thing, you bought the property artificially low, right? And people will look back and say, oh my God, man, if I was you, at that time, I would have done the same. No, you wouldn't have.
Correct.
Because you neither had the ability to find it, neither did you have the ability to manage it, neither did you have the ability to hold it, right? And you look like a bloody genius in the long run, but in that moment in time, it takes that fortitude. Would you agree with that?
Yeah, 100%.
Right?
Yeah.
Anything else, man, that I missed? Because I know we covered a lot of stuff. Anything else I missed? Because a lot of people, I'm sure they approach you. They're like, oh my God, Farris, you found a lottery ticket, dude. I want to do the same thing, right? What do you say to them?
There's no lottery ticket.
Right.
It's just hard work, diligence, understanding the deal. And the thing is about finding deals, you really have to have the knowledge to when something hits you in the face that's a $5-10 million deal to say, yeah, I'm buying that within 5 seconds of getting presented it. Otherwise, it could get passed out and shopped around to other people. So
let me ask you this. Do you feel like you have a pulse of, in the space that you're looking, you have a pulse for it? Because at the end of the day, the right deal hurts you. You know inherently, right, that I still have to do my due diligence. Not like I don't have to do my due diligence, but yes, inherently, this deal makes sense.
Yes, I have. I know, being a broker and obviously being in it and just looking at everything all the time, I know exactly what the market is looking for in terms of rate of return on their cash, rate of return on the appreciation, rent growth, and all that stuff. So when the return is just higher than what the market is looking for, clearly you're buying a discount to the market as your return is better.
Right. No, it makes perfect sense. Now, a lot of people are looking at plays like they'll buy an office building, try to do a conversion, go through this whole thing, right? They're like, Andrew, imagine what it could be one day, right? And there are a lot of people that are fascinated by very crazy ideas and things that are, I'm sure somebody thought about building the Taj Mahal, but that probably doesn't pencil out today. You, at least from talking to you, that doesn't seem to be your strategy. Am I correct?
Correct. I don't like crazy ideas. I don't like when someone comes to me and says, oh, what? I want to buy a HVAC business.
Right.
Okay, then go do it.
Yeah.
And let's see how it goes.
Yeah.
I don't want to hear the crazy. I just want to hear the simple and repetitive and do it. And you're not reinventing the wheel. You're buying something that's there, that people want to live in, and that you think is worth less at what the time you're buying it or what you're buying it for than what it is worth, in the future or currently what you're getting it.
Got it. Yeah, because a lot of people, I've always, I've had a simple belief: spend more time looking for the right deals rather than buying the wacky deals that nobody wants.
Correct.
Trying to make them right.
Correct.
Right, because that will drive you nuts.
Yeah.
And your rate of failure is extremely high when you buy stupid things.
Yeah.
And then try to make them into something. If you go to the market looking for a dog, don't come home with a donkey and expect him to run in the Kentucky Derby. You're like, man, Andrew, I tried. Like, yeah, but you got a donkey.
Yeah.
Right? It doesn't matter what you feed him, how much you train him.
Yeah.
Right? It's still a damn donkey.
Yeah.
Right? It's much easier to go find the right horse.
Yep.
Maybe that doesn't have the right training.
Yeah.
Right?
Yeah.
So, anything else you want to share?
I agree with that point, and I think there's a time and a place for everything. And it's some people take the time to look, but they're only looking for like this slam dunk home run.
Right.
But they won't take a deal that is a good deal, but just not as much meat.
Right.
So I think everything has to be looked at separately and objectively on who would lend it, how you could lend it, and then the deal itself, and kind of look at it more holistically than just the deal. But correct, take things that look like they make sense. It probably makes sense.
Got it. And are you kind of a little bit prejudiced towards the Midwest market?
Yes. I don't know how people make sense of numbers in these other areas. You see deals trading at $500K a door in LA with the rent as $3,000.
Right.
I can't understand it, so I wouldn't buy it.
I think with some of these things, I just 2 days ago had a conversation with somebody I know, and I've kept up with this guy. And every time I talk to him, last time I talked with him, he was at 700 million. Now he's like, man, we're at $1 billion plus. Right? I'm like, I'm like, what are you talking about, dude? You even know how many zeros there are, right? Because you throw out numbers,
Yep.
right? And this is a funny. He's like, Andrew, how do you afford an airplane? I'm like, what do you mean? I pay for it.
Yeah.
Right. I'm like, listen, man. When I tell you, if we own 300 units, we have a very simple philosophy.
Yeah.
Every property that I own every single month makes $500 a door.
Yeah.
Period. After all expenses.
Yeah.
They're like, that's impossible. I'm like, no. In your world.
Yeah.
I'm like, well, you should be maybe owning a fleet of jets.
Yeah.
Right. Because with the amount of numbers, and I'm like, how much cash flow do you make a month?
Yeah.
And he has no answer.
Yeah.
He has no answer for this. I'm like, then what is the point?
Yep.
Right? Is this a peeing contest? I mean, are we 14 years old?
Yeah.
Right? Because how much assets you own? I mean, just go work for $1 billion company or $100 billion company,
Yeah.
and you're a manager. Oh, I work for $1 trillion company.
Yeah.
What does that mean?
Yeah, correct.
Right? And I think we have gotten in this race of bigger and better, and bigger is not better. In fact, being strategic and actually owning assets that spit out cash flow and are worth a hell of a lot more.
Yeah.
I think that's what the thing should be about.
Correct.
So,
Owning your own assets and owning your own equity is better than
no,
being
man, this
bigger.
has been awesome. I was looking forward to having you because first time even when I talked with you, you made so much more sense rather than just go and raise a bunch of capital instead of paying more attention on where the hell am I going to deploy it.
Yeah.
Right. So this has been awesome. So if somebody wants to reach out to you, you guys do any retail business that people can reach out to you for?
Yeah, we do a ton of that stuff. EllsburyGroup.com. That's where they can find us.
Okay. How do you spell that?
ELLSBURY.
Okay.
Ellsbury.
EllsburyGroup.com.
Yeah, and they can go to my Facebook too and just reach out if they want to and ask me questions. I'm always available.
Okay, great. Guys, hopefully you enjoyed the interview. I think this has been absolutely great. I wanted to have somebody come on that talks a realistic game in terms of what you can do with multifamily properties. This has been awesome. Please make sure you like the post, you like the podcast, you share it, and help us grow. If you know of any great guests, we would love to have that. Again, you're listening to Andrew Holmes on Cashflow for Life. Talk to you soon.